Hey, happy Wednesday. I am Walt, and I'm here with another stock talk video. All right. So, last week, this is at least when I heard about it, there were conversations about implementing a 10% cap on credit card interest. Now, whether or not that's going to happen, I don't know. But two things I do believe will happen if that does happen, and that is going to be number one, a lot of credit card companies or credit card lenders will lose a significant amount of money, just from simple math, right? Like most credit cards, the interest rate on there is 20% and higher, right? Some as high as 30%. So if you cap that to 10% for a year, you're talking about them losing, in some instances, more than half of the profit they make off of interest. That's number one. Number two, that is going to have a negative impact, at least temporarily, in the stock market. And I think if we look at how the stock market did yesterday, I think that was one of the key factors into why we saw such a steep decline, right? If we go back to last year, in the first quarter and second quarter of the year, when there was a lot of conversations about tariffs, because Wall Street was uncertain about that type of impact, how far it would reach, what kind of financial implications it would have for a lot of these big companies, you start to see a lot of volatility. You saw a lot of selling off. You saw companies, like Google and Amazon, Nvidia, Chevron, Pepsi take steep declines, right? And I think similar to that situation last year, I see similar to this one, right? There's going to be a lot of buying opportunities. I know last year, I was able to enter a position into Pepsi, something that I was looking to enter for quite a while because of those declines, right? I've said this before. For me, I like to buy a dividend stock when for every $10 the current share price is, I'm getting 10 cents in dividend. So a quick example, at least 10 cents in dividend. Quick example, if a stock is $100, I need to be getting at least $1 per share in dividend. Now, last year, we saw companies like Pepsi, which I was able to get into, Clorox, I was able to add on to my positions, Chevron, I was able to add on to my position where I, couldn't because of the cost for a few years, right? And that was a great opportunity because you're talking about, Chevron, who has a dividend of $1.71. Not to mention, Google was a great growth stock that took a decline in the first half of last year, and then I believe it hit as high as it's over $300 something now, if I'm not mistaken. And one of the things that you have to remember when you're talking about these declines in the stock market, right? Our brains are wired to fear losses and to hop on gains, right? Your money, your wealth is generated when, especially in the stock market, when things are lower, right? So you have to remember, when a company like Pepsi is a staple, in the world, actually, and you see that there's these type of declines, you gotta educate yourself a little bit. Well, why is it there's a decline? Well, the entire market is in decline because of the financial impact of tariffs. Those are the times when you say, what, let me go and do a little research. What are they saying that they expect the average price of that stock to be? Oh, okay, well, they expect it to be 150, but it's at 110 right now, or 120. It's paying $1.45 a share each quarter in dividends. For me, that's an opportunity. So you cannot look at these moments, especially this first 2 quarters. There's going to be opportunities there to go in and buy some great companies for cheap, and that is when your wealth, your dividend income is going to grow the most, in these type of moments where there's opportunity. You cannot be concerned, you cannot be worried. Do your due diligence, do some research. I give you a perfect example. I remember when Google did their stock split back in, I think it was 21 or 22. I think it might have been 2022. I remember 2023 when the entire market was down because inflation was up, the interest rates were going up to fight it, and the market responded negatively. I kept buying. I had Google itself, I was in a negative, quote unquote losing money. Now, I kept buying because I saw that as opportunity. I understood that the entire market was in the red. I understood why it was in the red. I understood that Google is a giant, a money-making giant. And, fast forward today, I have over $20,000 in gains in Google, right? So, some stuff you just gotta, this isn't like trying to pick the next great stock, right? There are a lot of opportunities, everyday products, household products, stuff that you use every day, the gas for your car. There's going to be opportunities there, and you have to look long term, right? Remember, the wealth is built in the red. It grows in the green. You don't necessarily want to buy a stock when it's going towards its all-time highs. You want to get it before that even happens. And one of the things that you also think about, a lot of the stock splits that we've seen happen, right? Like when Nvidia and Google and Amazon and recently Netflix did the stock split, is because they understand that once these stocks get into the thousands of dollars, which they were before they did the split, they lose a lot of investors, right? They're pricing a lot of them out. So to make their stock more appealing, they did those splits. All, Google, Amazon, and Nvidia, since they've done their splits, it's been over a year or more, and all of them are more profitable. The stock has more gain today than what they had prior to the split. Right now, Netflix, they just did their split, 10 weeks ago. So it's going to take maybe another year or so before you start to see any significant gains to that stock. But I just wanted to say, this is what I'm going to be doing. I'm going to keep an eye on the market, start looking at certain high quality dividend stocks, capital gain stocks, and look at how much they may be declining in the next couple of weeks or the next 2 quarters because of possible legislative moves that could be beneficial to my portfolio and my growth. All right. So I'm Walt. If you have any questions, please leave them below and I'll make sure to get back to you.